Well, this is Current Yield, Grant's Interest Rate Observer of the Year. I'm Jim Grant, and with me, as always, is the great Deputy Editor of Grant's, Evan Lorenz. Good afternoon, Evan.
Good afternoon.
And you can tell by that the slight interval between my greeting and Evan's response that we are not in the same place, although sound travels at the speed of sound, doesn't it? It's pretty fast. But still, I am upstate New York, and Evan is in the terrific borough of Brooklyn. And today, it's not just Evan and Jim chin-pulling about trends in finance. We have with us Michael Knott, who is the managing director and head of U.S. REIT research. That's REIT research at Green Street. And I'm going to give you some of Michael's other CV highlights in just a moment. But first, I'm going to let you chew on this one. Michael earned a Bachelor of Arts degree in economics with distinction from Indiana University, Bloomington, Indiana. And
great
I think
school, right, Jim?
That's about as enough of an introduction as anyone needs, but there'll be more in just a moment. But in the meantime, ladies and gentlemen, and Michael and Evan, I want to ask you if the word Nathan Evans means anything to you. Nathan Evans, to narrow this down a little bit, Nathan Evans, age 26, of Airdrie, Scotland, just outside of Glasgow. Does that name ring a bell?
No.
No? Evan?
No.
Nathan Evans, on December 27th, got it into his head to upload a sea chanty from the 19th century, an American sea chanty called Wellerman. This is a song sung by whaling sailors awaiting the arrival of a supply ship, I guess someone in the Pacific Ocean. Sea chanty, right? And we learned them in the fifth grade or something. And so this is on TikTok on December 27th. And about 2 days later, I'm not sure how many uploads or downloads it earned 2 days later, but if you click on now, Wellerman Nathan Evans, you find 3.6 million views. That's just one version of this TikTok thing. This thing has gone viral the world over. And I bring this up, first of all, because it's an amazing thing, and secondly, because it speaks so much to our time of digital intimacy and physical isolation. I think that has to do with the popularity of this. Popularity is, a weak water word for what happened to this guy and this production, this Wellerman thing. It's just if you were born, say, in the 20th century, as some of us were, if you're born in the middle of the 20th century, if you were born in the first half of the 20th century, as some of us on this call were, it is almost incredible to consider these things. But I think, in a way, it speaks to the discussion we were about to have about real estate with the aforementioned Michael Knott, who is head of U.S. REIT research at Green Street, as I mentioned. Almost all of his career is at Green Street. He was at Blackstone for a spell, where he was the CFO of a U.S. office platform called EQ Office, and then he started out way back when at A.G. Edwards, not so far way back when. He's a CFA and knows all there is worth knowing on the subject of interest-bearing real estate securities called real estate investment trusts. So, Michael, belatedly.
And an avid Grants fan.
I didn't catch that last thing, Mike. Can you say that?
I said, and an avid Grants fan and paid-up subscriber.
Why, thank you. That's only part of the reason why Michael Knott is appearing with us today. By no means the preeminent reason, but it's a great reason, too. Michael, Evan pointed this out to me, and I have just finished reading with the greatest curiosity and with some satisfaction, something that your team produced on just recently, this month in February, first or so week of February. And it's called, the headline of this thing is Herd Community, clever pun, and it's about the rise, and it's kind of a Jane Jacobs thing on cities, right? It's the rise and fall of cities in the context post-Jane Jacobs of work from home and our present technology that has skyrocketed Nathan Evans to stardom at the age of 26, and now it's shaking up the United States of America. So, Michael Knott, is there hope for the real estate values in the city of New York?
Yeah, so it's great to be on with both of you. Thanks for having me. So just to set the stage for a second, so for those that aren't familiar, Green Street is a research shop, started in 1985, focused on really providing great insights to both public and private market participants in commercial real estate. We're, I think, uniquely positioned to help our clients deliver insights to them on both those fronts. We think it's important in the real estate world, given the private and public, to be bilingual, and so it's something we think a lot about.
I was going to say exactly that, but you said
well, thanks.
So, Michael, Evan and I we're office at 233 Broadway, which is kind of near City Hall in Lower Manhattan. And what we can't help but know is that nobody comes to work, at least not in the building. And this, of course, is by no means unique at 233 Broadway, the old Woolworth building, the great dowager of New York City skyscrapers. It happens to be ubiquitous throughout Manhattan, and I dare say the outlying boroughs as well. Like these buildings are standing, not quite empty, but the point survives the exaggeration. How are they valued, and ought they to be valued as they are valued?
Yeah, so it's a really intriguing question, and there's a bunch of different angles here we could talk about in terms of the economy, in terms of COVID winners and losers. Although I think, in our view, COVID analytically is almost passe now. We've focused a lot on it in the last 9 to 10, 12 months. Been really important, but I think we're starting to move past it. But there have been some sectors and some property types that have been greatly impacted. We've had a huge divergence between winners and losers across the almost 20 different property types that we cover. So there's lots of different types of real estate to talk about. Obviously, office is one of the oldies and goodies. New York is the most important U.S. office market, arguably, certainly the largest. And so there've been, with COVID, some acceleration of trends that were likely to happen anyway. We could talk more about that. Retail, for example, being having negative impact from e-commerce, industrial benefiting. We think some of these trends will last beyond COVID, and office is one example of that. And so just to set the stage for a second, all the way back in, I think it was May or June, I think we were one of the first firms out there to put a forecast that we thought office would see a pretty meaningful impact from changing behaviors as it relates to work from home and how folks are adapting their daily routines. And so we initially said, hey, we think office will see between a 10 to 15% hit to demand as a result of these changing behaviors, which is a pretty strong statement. And as time has gone on since then, in the last 6 to 8 months, there have been a number of, countless actually, I'd say, a big number of surveys of company announcements, particularly in the tech sector, about how they interact with their employees and how they all work together, remote first or hybrid. So we think the office will survive and will be an important part of how companies teach their employees, how they collaborate, how they engage, how they provide culture to their employees and maintain that ongoing sense of continuity of employees and managers. So we think the office will survive, but we think there will be a negative impact. So your question was specifically about New York and about office. Office utilization has been, as you pointed out, pretty low since the onset of COVID. And New York really has been no different. In fact, probably worse than a lot of places. So we think office is a sector that is fraught with challenges from an economic standpoint. It's a difficult business, a lot of CapEx, and it's been so-so for most of the past decade compared to a lot of other property types and compared to how office has performed in other up cycles since the mid-90s. So office, our outlook's a little bit dour, I would say, compared to most. But again, there's been a lot of the recent
Michael,
headlines. Yeah.
Getting back to the question of price, for much of the last decade, pensions and sovereign wealth funds treated New York Class A office buildings almost like they were inflation-protected bonds. They were willing to pay almost any price for them because they thought these are trophy assets in gateway cities, and they'll get inflation pricing or more over time. Have we begun to see a reappraisal by global investors? And if so, are we seeing cap rates gap down or gap up for high-end New York office buildings? I think before COVID hit, they were actually trading with like a 3 handle, so 3% and change. Is that still true? I'd love to get a sense of pricing today.
Yeah, sure. So we like to look to both the private market and the public market to get a sense of pricing. We think the public market, again, going back to my point about being bilingual in commercial real estate, public market can tell you a lot. There's a lot of aspects that are leading indicators. And so most property types trade in the public market. Several trade at a premium to underlying private market asset value. Office continues to trade at a very large discount, and this has been persistent for quite a while. So in the public market, the average cap rate across office generally is 7%, about a 20% discount to private market values. And in the public market for some of the New York REITs, you can find cap rates on, say, an SL Green in the mid-sixes, but some of the other players with New York office exposure are into the sevens. So cap rates have moved up pretty meaningfully, and I should point out that for the totality of COVID, office has been the biggest loser across sectors in the public market. You've had a pretty big recovery in some of the more challenged property types since the vaccine news came out in November. So totality, last February to date, office is the biggest decliner on an unlevered enterprise value basis in the public market. And in the private market, there hasn't been a ton of trades to really give us a great view into where private market values are. In our NAVs, which we focus a lot on high quality NAV estimates for all the 80 plus REITs that we cover, including almost 20 different office REITs, many of which are focused in New York. And, for example, for some of those folks, we're using cap rates. So again, private market values, cap rates on 22 NOI in the mid 5% range, sometimes a bit lower. So they have moved up. I think pre-COVID, New York office cap rates had been inching up a little bit. There was a lot of, again, pre-COVID, a lot of questions about cap rates for, say, single assets versus larger portfolios, and this idea of a portfolio discount, which is a big contrast to the mania that you almost had. I would describe mania in 06 and 07, where New York office was, in fact, trading at 3 caps.
Michael, let's bring this down to the level of the investor, not down to the level, but let's clarify for the interest of the retail investors looking for yield. So if you would please give us an example, kind of a composite example of where one of these real estate investment trusts might have been trading in the last days of 2019 before we all heard about the big bug, and then where it's trading today. This is with respect to dividend yield received.
So I don't have that dividend yield pre-COVID offhand. We focus more on real estate values, expected returns. We look at overall earnings.
Express it any way you want to, but how has valuation changed?
Yeah. So again, going back to this analysis of enterprise value, so a company as a whole, including debt, so an unlevered basis. Office is the biggest loser across the different property types, and it's down something like 20%, which is the worst across different property types. So COVID has said New York values are down quite a bit as a result of COVID.
Yeah, that's down 20%. Of course, is a big fat number, but it's not so big and not so fat as like the down 80% or more of people who actually go into these things to work. And I'm wondering whether the market has truly taken the measure of, as you put it in your February 9th piece on the tail risk.
Yeah.
The intriguing thing about this essay, by the way, is this posted on the Green Street website, or is this for clients only, or how may our listeners, if at all, may they see it? This is we're
a subscription
okay,
research
fair enough. Okay,
model.
So I won't give away too much of this, but I will say that this is this essay is an intriguing comparison of what happened to such cities as Detroit,
right,
from starting in the mid 20th century, and it holds out the possible analogy that that air conditioning was the seminal technology that changed migration patterns and real estate values in the middle of the 20th century and a little bit before that,
right,
but principally the mid to late 20th. And that redistributed the population of the United States into the Sun Belt. So this Green Street essay asks provokingly, interestingly, whether Zoom might not be the air conditioning of the 21st century, in which one suddenly can throw out all preconceptions about where one must be between the hours of 9 and 5. And this could have possibly very, very, disruptive consequences for the real estate values of, say, New York and San Francisco and other so-called gateway cities.
Right. Yeah, to be very clear, we're concerned about New York and San Francisco. We think there will continue to be migration to the suburbs and then some migration toward the Sun Belt. We think that the COVID trends, the work from home, the Zoom, fiscal health being poor, particularly in New York. We'll see what happens in terms of funding from federal government bailouts. But we think there's all kinds of factors that suggest that this mega trend of the last 20 plus years of urbanization could stop or potentially even reverse a little bit. And I think Evan mentioned a minute ago sort of the institutional investor love affair with New York buildings, and that's been the case, as this mega trend of urbanization has played out to the benefit of gateway markets in a big way, but we're concerned that over the next 10 years that these trends will work against some of these places.
Grants produced a piece in June of 1999, and the headline was "The Economic Consequences of Air Conditioning." And we wrote this. I remember it because I wrote it, and I remember very well the provocation for this piece was the internet bubble and the crazy prices that people were paying for such obviously temporary business models as Amazon.com. My bad. But what I did was to trace the economic consequences of, and the business model of, and the financial valuation of the air conditioning revolution. And what I discovered looking back through old data was that Carrier Corp, which was what would Carrier Corp have been in as a metaphor, a little bit like Amazon and its dominance of a technology. It was trading in the 50s when the business of air conditioning was then thriving. It was trading at 5.2 times trailing net income and 2.4 times annualized net income of the latest very prosperous fiscal quarter. And the stock yielded 4.25%. Treasuries were 2.65. So this was the agent of this revolutionary change in American migration and real estate patterns, and it was valued as if it was valued as if the world had had a 20-year only break from the Depression of the 30s and the World War of the 40s. So it shows you a little bit, I thought then, and I think now when rereading it, it shows you that the innovation is not everything. It's the context in which innovation occurs that can have a lot to do with the way assets are valued, and yes, including, I would suppose, office and other commercial real estate values. So these things today are valued in the context of free money, the expectation of more free money, the expectation of unlimited fiscal support. And maybe that's the reason why I say only down 20%. It's not going to seem only to people who are holding the securities, but it seems like a fairly mild pullback. Evan, you came across on a Bloomberg story about the bargains that are not present where you would expect them to be, right? Like a hotel business?
Right. Yeah, Bloomberg had a report 2 weeks ago, and they basically said it's the worst year that hotels had faced basically in modern history, and I don't think anybody would argue that.
That's right.
You would expect hotels to be cheap because of that, but you'd expect hotels to be cheap because of this, but because there's so much money chasing distressed assets, in fact, there's no bargains to be had, and that seems one of the contradictions for this market.
Yeah, exactly. I mean, there's, as you're well aware, right, there's just unprecedented amounts of fiscal stimulus that's likely to continue to come. There's been unprecedented monetary stimulus from the Fed. So I think we're going to continue to have this, I think, K-shaped economic recovery, thanks to K Street in DC, we could talk more about the economic outlook later perhaps, but we are there's some interesting things there as it relates to the underlying health looks really good right now. Concerns about debt and demographics, the Van Hoysington type views, but as it relates specifically to lodging, yeah, it's an unprecedented operating environment to the downside. The hotel REITs have been reporting greater than 100% declines year over year in EBITDA, so they're unprofitable at the property level right now. But they are at least the big sponsors and operators are almost uniformly securing multiple rounds of covenant waivers from their lenders. So there's been, in part due to all the stimulus and everything that you cited, there really has not been any kind of feeding frenzy or opportunities to capitalize on that operating distress because the environment is so liquid. So
I wanted to ask you one thing about
continue.
Michael. So you're in Newport, California, which shows that you know more about where to live than I do, and it kind of shows that Green Street knows real estate better than I do. But walking through Brooklyn or Manhattan right now, you are struck by the number of restaurants that are closed, retail stores that have boarded doors, office buildings that are largely empty, but we're not seeing like a lot of landlords mail their keys back to banks, and we're not seeing a lot of distressed transactions. Part of that was due because the CARES Act allowed banks to defer problem loans, and a lot of banks gave deferrals, especially to commercial landlords. Just given what you see in terms of supply demand and the kind of trends in work from home, do you think that we're going to see more workouts in commercial real estate? And if so, how big is this problem?
So I think within the office space I mentioned earlier, we think there could be a 10 to 15% type hit to demand over time. There will be winners and losers within the office industry. There will be winners within a given market. There will be winners and losers across markets. We think Sunbelt will be a winner. Places like Austin, Miami, Nashville, Raleigh, et cetera, will be winners. We think New York and San Francisco will be losers. But even within on a relative basis, that is, within a market like New York or any market, we think there will also be winners and losers in terms of higher quality buildings faring better. I think there's going to be a greater, as tenants eventually think about how they implement their remote work and work flexibility with their employees. The office will remain a fixture for most companies, but the utilization will change. I think companies, at least some companies, will implement a bit more hot desking. The Wall Street Journal recently had a story about the death of the desk, saying your office may survive, but your desk probably won't. So we think implicit in our forecast is some greater adoption of hot desking and some degree of losing personal space. So as companies migrate more toward higher quality buildings, there will be, I think the lower quality, older buildings will suffer more.
Yeah, this hot desk, I don't know. I don't think the HR department's going to like the sound of this. A lot closer proximity, a hot desk. It sounds like the kind of thing that got a lot of people into trouble. Okay, I'm just going to get that out there. Hey, apropos of companies losing money, like the hotel REITs losing money, and nobody seeming to care very much because of the accessibility of cheap and ever so confident workout capital. Here is the fellow who started Carrier. His last name was Carrier, and his view was that only profitable companies, only profitable businesses could work. He said, quote, "I fish only for edible fish." So the inventor would say, "I fish only for edible fish and hunt only for edible game, even in the laboratory." And one of the things that's different now, this harkens back to what we all agreed to before, was that, the kind of the worse the better, right? This year has been, the past 12 months or so, has been an extraordinary time for unprofitable companies. It's been an extraordinary time for zombie companies, meaning companies that aren't earning the cash flow, not EBITDA, but earnings before interest and taxes to service debt over the course of 3 average years, right? So all of this adds up, it seems to me, to the likelihood you're not going to see many investment bargains. But, Michael Wilkins, do you see at Green Street, any really compelling investment values out there in the real estate world, in the real estate investment trust world, in the private world, what have you? But our listeners have to know if there are any great bargains, because they're going to go out and snatch them up before the other podcast listeners get to them. So tell us.
Right, right. So overall, we think real estate is actually cheap in the private market. So we look at that compared to corporate bond yields. We don't look at sovereign bond yields. We like to have something with some credit risk embedded in it. So relative to corporate bond yields, real estate in the private market looks cheap. Now, again, I mentioned COVID has created the greatest divergence between winners and losers we've seen. And so the broad brush statement of real estate is cheap has to be nuanced with, well, it depends what you're looking at. Green Street's always had a preference for lower CapEx property types. We feel like those sectors that are less capital intensive over time tend to be more attractively valued. That tends to be true both in the private market and in the public market. So we've long thought that CapEx is not properly accounted for in a true buy and hold type analysis of real estate pricing. So with that being said, some of the things we like are some of the residential sectors. So we really like manufactured housing. We like single family rentals right now, which are extremely hot in terms of the operating fundamentals. We like also net lease casino investments, which is predominantly a public market vehicle, and that's one of my top individual security picks that we have at Green Street, and I can talk more about that in a minute. I'm sure the listeners might be interested in that. It's actually a really good yield play. So those are some of the things we like, and in the public market, we like some of those same things. So the net lease gaming, manufactured housing, single family rental, and the apartment space, which we think is not so attractively priced in the private market, but we still feel that it's overly discounted in the public market. And then by contrast, some of the things we dislike are the higher CapEx property types, office being one of the higher CapEx sectors. Lodging, we were just talking about that, is also CapEx intensive. So that tends to screen less attractive for us. Lodging and office really are good trading businesses. And so again, this analysis I'm referring to is more of a buy and hold approach. So lodging and office typically won't fare as well. But historically, those have been more trading business. So Mike,
in the 2 minutes we have left, do tell us about yield opportunities in the gambling business. Oh, gaming. I forgot to use the gaming business.
So what if I told you there was a secure cash flow stream where you could generate roughly a 6% dividend yield that has coverage and where the underlying rent payment that the REIT is collecting is well covered, and the REIT didn't miss any of the rent payments due during the pandemic. So the ticker here is MGP, and that is the REIT associated with MGM, the casino operator. So the gaming REIT business was created during this cycle several years ago. There's really 3 REITs that are basically tied largely to one operator. So MGP is the REIT associated with MGM. MGM continues to own a very large stake in the REIT, and as such, it's really under-owned by a lot of the indices, and so that's an opportunity. It's a little bit ignored, but the rent coverage is pretty solid from the operations. MGM is pretty liquid, and so the credit profile combined with MGM's liquidity is pretty good. Pre-COVID, the rent coverage was about 2 times. The EBITDA was 2 times the rent, and there have been margin improvements to the business since COVID. So obviously, some of the Vegas casinos are still getting back to normal, obviously, but no rent payments were missed. 6% dividend yield. We like that one a lot. It feels like equity-like returns for bond-like risks, because these are long-term triple net leases. So we like that one quite a bit.
Michael Knott, thank you. This has been most educational and most interesting. And keep these wonderful analyses coming. That's my request of Green Street. Michael Knott, I thank you for being with us. Evan, delightful as always. Olaton, thanks for an excellent job in your capacity as sound engineer. I am Jim Grant on behalf of Grant's Interest Rate Observer. Thank you for listening. We'll talk to you again soon.